Thank you very much, Dave. Good morning, everybody. It's a great pleasure to be here and have a chance to have a chat with you about what it says there, operational excellence. I'm cautioned by the comments made this morning that there are mainly explorers in the room. I'm going to talk a little bit about exploration. I'm going to talk a little bit about development, a little bit about production as well. And also, I think the comments made earlier this morning have set rather an interesting tone. This is an industry where we can get a little bit self-analytical and a bit worried about how good things are, how bad things really are. Let me start with some good news. We produced about 91 million barrels of oil last year, about 45 million barrels oil equivalent of gas. Pretty good, pretty good. I think it's about the 20th of June 2024, we'll produce just over 100 million barrels a day of crude oil and 55 million barrels a day equivalent of gas. It's pretty good, right? For an industry that's self-absorbed, rather reckless, doesn't understand risk and spends a lot of money. It'll be doing some fantastic things in the next decade or so. The challenge, of course, is that to get to that 100 million barrels a day of crude oil and 55 million barrels a day of natural gas equivalent, we've got to put in service about 70 million barrels of new capacity to do that. Now, we can either improve what we have, we can make it work better, improve recovery. We can develop what's been found, or we can find some more. Pretty simple, eh? Those are the three options we have. And, or we can exchange a lot of stuff and move it around the industry. But essentially, we've got three choices as to what to do to realise that. The Shale Revolution, much talked about. Lots of people very excited about it. Lots of people very worried about it. Lots of people a little dismissive of it. But again, as I start to think about this topic, the Shale Revolution is very good because it just wakes us all up a little bit. The good news is, I think 4 million barrels a day of production came on stream. The bad news is that some of that hydrocarbon sold at $33 a barrel last year. So whilst heavy crude oil in Canada was selling at 103, light crude oil in the middle of the US was selling at 33. So we live in a strange world. Where some of the numbers are a little bit baffling and some of the challenges that we have are hard to put your finger on. But let me have a go at talking about some of those challenges from an operational perspective. It's an area where, as Dave said, I've spent quite a lot of my career working around the industry with the big national players, the big independents, the multinational players, all kinds of industry performers. And the conversation is very similar in all of those places. But let me take you through a few things. Much used our friends at Exxon, but the idea of what performance actually means, I think that the title for your talk today, or the date today, is about performance. Performance is, in this industry, other than the numbers I just quoted about gross production, are a bit self-regulated. We choose our own performance metrics. Here's the biggest commercial player in the industry changing its performance metrics. Down here, we talk about production. They did have a target in 2017 of 4.8 million barrels a day. At the end of last year, that kind of changed to about 4.3, or somewhere between the two. And that's quite a big margin of error, right? It's quite a big margin of error. Up on the other chart there, it's just about production costs, and I'll come back to that. But those are going up. And it brings to mind two words, which I'm going to talk about a bit as I go through this morning. One is about predictability. How well does this industry able to predict what it's going to do, the promises it makes? And how affordable is it? Can we afford to do what we're doing? I think, Alistair, you mentioned around $1.50, something like that, to find hydrocarbon. Well, the super majors last year produced hydrocarbon at about $23 a barrel on average. So $1.50 to find it. Let's step out of appraisal development costs, but about $23 a barrel to produce it. That's oil and gas. So gas at $23 a barrel average is pretty expensive stuff. But let's take a step back and think about what this industry's done. We're talking about excellence. We're talking about delivering on something that the industry has undertaken to do. This rather elegant picture describes the strategy of the super majors for the last decade. It contains a rather unfortunate boomerang effect. What it says is at the beginning of the decade, around 2002, pretty much everybody was on the same track. This is a group of 8 very large companies spending a great deal of money. In 2002, they spent about $70 billion on capital expenditure. They produced, as you can see here, just over 20.5 million barrels a day equivalent of production. Every single one of them launched on a heroic strategy of growth and expansion. Yeah, we were all going to grow production at, pick your number, 3%, 4%, 5% per annum. And off we went. The industry then hurtled off to the right here. As you can see, expanding production was relatively straightforward through to about 2006 in this picture. As you can see also, the investment did increase quite substantially. Now my graph doesn't show you that as dramatic. It only goes from about 70 to about 100. It's only a $30 billion increase in expenditure. However, since 2006, we saw the industry sort of stall at around 22 million barrels oil a day equivalent for this group of companies. Really stall in terms of growing beyond that number seemed to be very, very difficult to do. We can then argue, well, was that because some of the major projects started to slow down? Was it because we started divesting assets? Was it because we couldn't get access to new areas? But nevertheless, the promise had been made back in 2002 that we were going to continue to grow. So the industry then uses its substantial balance sheet muscle and its substantial deep pockets and its substantial risk appetite to continue to invest. We managed to get to $228 billion of expenditure from the same group of companies last year, so a threefold increase in CapEx. Sadly, production is just behind where we started. So we are, 10, 12 years further on, $1.4 trillion has been spent, and production capacity is about where we started. Pretty good, eh? Pretty good. So that's a little bit the reason why you see most of the major companies today and most of the shareholders today saying, hang on a minute, what's going on? Did we set the wrong targets? Did we do the wrong thing? Should we have spent that money? What should we do now? So where's the arrow going to go? Well, I think it's pretty predictable to say the arrow is going to come down in as much as in this year and next year we'll probably see this group of companies spending a little bit less, right? That's the prudent thing to do. Sadly, when you do that, something else happens. It means production is likely to come down from that group of companies as well. So this picture is going to be even more interesting when you see it again next year. It'll have a little hook on the end as the arrow comes down. But this is the simplest depiction I've seen as to why the industry gets itself in a bit of a tangle. Because it chases after an objective. One and all, it was a good idea. We need to expand production because the world is demanding more and more hydrocarbon. As I said at the beginning, by 2025, we've got some pretty big numbers. We've got some pretty big challenges. So what's wrong with this picture? Why are we stuck in a world where things don't look to be going so great? Well, part of the problem and part of the opportunity, I would argue, is related to what it is we're working on. This is a depiction of where most of the liquids production comes from, and it just shows you what sort of maturity those fields have. The red being those that have been in production for more than 10 years, the grey being those that haven't been in production for more than 10 years. And you can see the picture's pretty simple. It says we've got a lot of work to do on the mature fields. So as I said at the beginning, we can do more with what we have. This is a group of fields where the recovery factors are something around 35%, which means 65% still in the ground. And that is the bulk of our installed capacity for production base at the moment. A lot of opportunity sitting in that red area to do better, to do more, and to deploy potentially more capital and effort, technology, and inspiration, I think was the other word that came out this morning. Into that red area. The grey area really is to be tested. The question is how much quality is in that grey area. Have we got all the best assets in the red? Are they the older assets we could do more with? Or is there a lot of quality sitting in the grey? Again, a big challenge for the industry to figure that puzzle out, because deploying your time and resources, your best people on these different kinds of assets makes a big difference to the outcome. One of the features, though, when we talk about how well things work in this industry is it's not really under our control. we've sadly seen a proliferation of incidents and events around the world which actually have a very significant impact on the oil and gas industry. We hear about the sad news in Iraq. We've seen the impact in Ukraine in recent weeks. But this is a picture which, when you start to flick around the world in the last few years and say, well, what's going on? Even Scottish independence, it seems, is the stuff which the oil companies want to get involved with. Both Ben Van Burton and Bob Dudley had points of view on that, as I recall. Not just J.K. Rowling, but the oil and gas guys too. So we're not necessarily able to deliver performance unimpeded. We're trying to deliver performance in the context of an increasingly complex world. And you've got a marvelous phrase which is called non-technical risk, which is the bucket of things that all of these things fit into. Non-technical risk really is the biggest impediment to advancing some of those appraisal volumes you were talking about, as to some of the slowdowns in the CapEx program. Some of the production difficulties are very significantly related to these things. So non-technical risk is an increasing thing that a lot of companies are beginning to focus on, not just the commercial companies. One of the most significant sets of non-technical risk right now for an oil and gas company is in Mexico. We have a dramatic change taking place in the Mexican industry, a dramatic reformulation of how that industry might work, and particularly how Pemex will work. Nothing of that is to do with the technical characteristics and the hydrocarbon potential of Mexico. It's all to do with how the political, commercial, and other features of that industry play out. So non-technical risk is a big, big part of the puzzle. Shortage of people, yeah, we bang on about it, but actually if I look around the room, I'm one of them, slightly grey-haired and hoping not to do this forever. That's the feature of the industry, and we see a lot of that out there right now, where folks are beginning to worry about the quality and the pipeline of folks who will produce that 100 million barrels a day in 2024. Who's going to do that? When we think about getting this right and figuring out how to perform a little bit more effectively, a little bit better, and a little bit better means a lot of money, by the way. I think the automotive example of 20% here and there is very interesting, but 3 or 4% improvement in this industry makes a massive difference to the financial outcome. But there are 4 things to think about: the capabilities, business performance, the productivity and potential of the assets, and managing the stakeholders, as I said, that non-technical group. Let me just share with you a couple of observations around each of those, and then see what it all adds up to. One of the areas that we've spent a lot of time at Bain thinking about and working with the biggest and some of the smaller players in the industry around is the capabilities that companies have. What are we actually good at? What is it that we can rely on in order to be able to execute? I've chosen here a subset of things which are interesting perhaps to this group. On the far side, talks about wells, production operations, reservoir management, OBO, non-operated activities, which also came up earlier, technology and HSE. These are essentially things that if you can get these things to work well inside your company, whether it's a national or commercial company, then you've got a much better chance of delivering on your asset base. I think the previous discussions were focusing a lot more on the quality of the assets. This is the quality of what we do and the controllable factors within inside a company, and does that have a big impact on performance? Well, you can be pretty darn sure it has a massive impact on performance. I've picked out several areas here in yellow, and these are described as tenable areas. These are places where you find very, very large oil and gas companies with capabilities that are insufficient to get the job done, insufficient to deliver on the asset base that they have in front of them. But nevertheless, they still continue to work those assets. Let me just take a wander through them for a moment, and we can stare in wonder about how it works, this industry. Big problem in wells, workovers. Big problem. Big problem. Not just getting them done, not just scheduling them at the right time and coinciding them with the right maintenance cycles, but well workovers is an area of activity where increasingly it's going to be difficult. As we're in tight formations or whether we're in deep water, well workovers are big exercises, and they take a lot of time, a lot of effort, a lot of money. And the level of effort that goes into well workover versus drilling is quite startling. And the kind of people that people are deploying onto workover programs, again, are quite different than they are in the actual original drilling operation. So workovers is a big watch-out area, and it accounts for about 15% of production capacity. Potential gets dropped out because of poor workover. Scary, isn't it? Remember the big numbers I was talking about before? About 15% of production capacity. If wells were worked over on a well-planned, predictive basis, and they were executed well, we would have a very significant uplift in production capacity. It's like cleaning out the pipes, switching your boiler on before springtime is finished. Autumn is finished. Getting down into the other production operations activity, maintenance planning and execution. Again, we all know this. It's not a great revelation to say that maintenance planning and execution is not very good or could be substantially better. But this is going to be a massive challenge going forward, particularly as you saw I had a chart that said how many assets were over 10 years old. The first 10 years of the production operation experience is somewhat more straightforward than the next 10 and the next 10. As the unconventional world in North America moves forward, as it gets into its second decade of operations, you'll see maintenance activities becoming a very big part of what's going on there. It's a rapid replacement cycle already, but when those assets become quite mature and the facilities become quite mature, we've got a whole new raft of investment required and challenge to address. Reservoir management, fantastic. This is the area where I think that we've got the most excitement in the next decade. Again, the comment that was made this morning about we're sort of explorers in this room. Well, explorers hopefully will have a very big impact on reservoir management. Continuing to explore the reservoir through its life is a massively important part of what this industry can do. And again, there's an interesting piece of work I saw done actually in my own firm a couple of weeks ago on what they call big data. This is how industry is going to use big data in the next decade to enhance its activity. And right at the very end of the list of industries were mining and oil and gas as those industries that were going to use big data efficiently. So I took the people aside who prepared this analysis. How on earth did you come up with that? This is an industry that works with a huge amount of data, massive. I said, but they don't do anything with it. Once you've found something, you don't do anything with it. Here is, I think, a massively important piece of the equation is how we'll use information and information technology, how we'll get into predictive activity. Again, predictability was the word I picked out earlier on. This is about predictive analysis, using reservoir performance information to predict how the reservoir is going to work, but much more accurately than we do today. And I'll show you why in a moment. Non-operated business, I think, again, we saw the numbers this morning. People really are bad at non-operated business. They spend too much money at it. They are very critical of their operator, having already chosen them earlier in the process, and the results don't match expectations. But this is an industry where we've been collaborating for decades and decades and decades. Non-operated business does not work very well. Joint ventures do, strangely enough. So the OBO category, or partner-operated license, or whatever you like to call them, is an area of very low-hanging fruit where, again, many folks can both improve the way they do it and what it is they're trying to do with their non-operated business. I see there are a number of BP folks in the room. BP's operated portfolio used to be 80% of what you did. In the future, it's going to be closer to 50. So you've got to get this right. And for all of the other company reps in the room, the direction of travel is similar. Non-operated business is growing as a proportion of the overall activity set. Down into health and safety, behaviours and culture, and people and process safety, again, are the two biggest red flag areas that we see as we go out there. And the correlation between performance in those two areas and actual business results, whether they be exploration finding success well performance or production performance is extremely high, particularly the people process safety aspects. The statistics are very compelling. The linkage between the two inseparable. Let me move on a little bit in terms of putting this back into a bigger picture. So performance for performance sake is very interesting, but performance for an outcome is very important. And shareholder value, whether you're a government shareholder or a commercial shareholder or an individual with your money in a pension fund, the outcome is extremely important. And the connectivity between getting performance right and shareholder value is sometimes very hard to draw. Now, this is a very simple picture and shows you some low percentage numbers that have very high impact on the outcome. What we have here are 4 characteristics around understanding risk a little bit better, understanding the output and the variance of output in production terms, the cost of running an activity, and the capital employed in running an activity. If you can get your business activity to work within these boundaries, that means on the risk parameters as low as predictably possible. That sounds very sensible. On the outputs, you should have a plus or minus 3% swing. That's what the downstream business does. I think someone mentioned that earlier. It's very, very hard to see that in the upstream. I'll show you why in a moment. Total costs around a 7% swing around the expected outcome is a good performance. And on capital employed, a 3% swing around it is outstanding. A 3% overrun on a $10 billion project is quite expensive, but it's very, very common. A 25% overrun is also very common. So getting these performance statistics in the right bounds is really very, very critical, and something which many companies are spending a lot of time trying to get better at. All right. Let's talk about production. Production's an interesting thing. I don't suppose there are too many production ops people in the room. Is that right? Not too many. Yeah? Excellent. Right, so can you cover your ears for just a few moments while we talk about production ops in this manner? This is a picture. It doesn't really matter too much what the picture it is. You can see a blue line that wiggles around quite a bit, right? That's actual production from a UKCS large field. It's a 200,000 barrel a day type asset, which is quite large, right, for the North Sea these days. That's a pretty big asset. But you can see what's going on there is, this is monthly production over 5 years. What you can see going on there is a lot of variability. So month on month, high degree of volatility in the production outcome. The cause of that, I won't even speculate what it is, but there is a high degree of variability. The dotted red line shows you the average actual field delivery number, and the green line at the top shows you an indication of what the theoretical potential is. And you know what? For this asset, the dotted line at the top is the planned number. It's the planned outcome. This field is running at about 67% of its full potential. 67% of its potential. This is a big asset. Let me show you a mature asset in the North Sea also. This one's running at about a tenth of that size, around 20,000 barrels a day. You can see the same kind of picture, but you can see the decline over 5 years as that mature asset comes through into its late life. But look at the volatility on this asset. Look at the volatility in the asset. The actual production performance of this one is actually worse. So this is an asset that's been in operation for well over that 10 years, so it's in my red box of production assets. And the performance of that asset is just unpredictable. What's production going to be next month? I have no idea. History would tell you whoever's running this asset also has no idea what it will produce next month. Does that cause a problem? Yeah? Causes massive problems. Massive problems. How do you support an asset like this? How do you provide the right infrastructure? How do you provide the right people? How do you provide the right goods and services that will support it? And how do you get the downstream folks to sell the product? Massive problems, massive problems. So what does that do for you? Well, it means that, sorry, let me just go back 1 second, because what you see most companies do in response to these kind of assets, and both of these are big, sensible assets owned and operated by big, sensible companies. But what they try and do is they say, we have to improve our operational performance. Makes sense, right? You would too if this was yours. Or if this was yours, you would too. But what they do is they try and set a higher target for production. They say, what we've got to do is get production up, so let's increase the target. Let's throw some more resources at it and increase the target. Well, sad to report that most times when people do that, they get more volatility than this, if it's possible. Because what you have, if you take all of those monthly or even daily production statistics and look at them over time, the standard deviation around the outcomes is very large. The predictability is completely missing. You see this asset or set of assets here shows a very significant shift month on month, and I can be way down in my expectations. I can occasionally be above my average, but not often. So the story is really getting that performance to be much tighter first. So the first thing that again we do with folks when we're helping them with delivery of better performance, whether it's a production asset or an exploration program or even a development project, is actually narrowing the band of performance. You've got to get this thing to be much more predictable. You may not like what it's predictable around, you may not like the number, but you have to get the band to narrow, and then you can start to improve performance. So for this asset, its major problem is getting rid of the wings on the distribution. So you get a very tight distribution, and then you can improve performance. If you go at it the other way, it doesn't work well at all. So, sorry about the production operations bit, but production operators are not often the problem here. This is actually a lot to do with the whole system and how the whole system works. Some argue it's about planning. Do we set the right targets? Well, we can have a very long discussion about right target setting, but when you have an asset like this that delivers these sort of performance numbers, you can't set targets. It's very, very difficult to do. Okay, just to come back for a moment to the other part of the puzzle that we were mentioning, the stakeholder management piece of this is tremendously important. This is much more to do with the development phase and to do with the exploration phase. Stating the bleeding obvious, but if everybody agrees, then something's likely to happen. If someone disagrees, it's likely to slow it down. If everybody disagrees, it ain't going to happen. Simple stuff. But again, the industry is one where getting consensus, getting buy-in from people takes an enormous amount of time. An enormous amount of time. And the kind of amounts of money that we have employed in the industry mean that time is very, very expensive. Very, very expensive. How expensive? Well, if I take a very, very large European oil and gas company that has about $80 billion of capital employed, it's got about 23 of those $80 billion sitting in assets that aren't doing anything because we haven't got agreements around what's going on with those assets. So about a quarter of its capital employed is stuck. But it's about getting alignment. We've got some pressures on operating performance there, but getting the stakeholders to understand why costs are rising, why production efficiency may not be as good as we predicted it would be, why technical complexity is increasing, why the workforce isn't the workforce that we started out with. All of those kind of issues come onto the table very, very quickly when we start to get out and try and deliver performance. The stakeholder group or the non-technical risk categories then come into force. If you have these 4 features in your business, then your stakeholders are going to get very, very angst and start to try and help you make decisions, which may not be what you need. Okay. Where does it all lead to? I think operational problems are just a fact of life in this industry, but it's the extent of those problems and the addressability of those problems which causes the most worry. There's a list there, A through F. It's not necessarily in a priority order. It's not necessarily observable everywhere, but it's pretty common practice in most, as I said, of the major international companies and the most of the major NOCs that we work with, to see production shortfall versus plan. There are very few companies out there who are able to produce on plan across their portfolio. We see slower than anticipated project starts, but not just once or twice, but year after year after year after year. Through that period from 2002, a very consistent view of the world is production starts up, you know, 1 or 2 years after we expected it to, but we still put it in the plan to happen when we think it might. It's an extraordinary setup. Health, safety and sustainability challenges are widespread. These are risks and factors that often get, again, left out of our planning and our performance management activities. Inflationary pressures and bottlenecks in supply chain, and particularly in the midstream part of the business. I think if there was one thing that has been a bit of a surprise to us in the last 3 years is the number of times we've been asked to help folks with midstream challenges. The midstream has become a massive part of this industry in terms of new investment taking place, but also a massive part of the industry in terms of we've forgotten how to run big midstream assets. They require a different kind of skill set. They require a different kind of ingenuity to get them built in the first place. But when they are in place and running well, they can be the difference between the kind of returns 15% plus that we've been talked about this morning and sub 10. You know, get your midstream right, and there's a big prize to do that. Maintenance and plant availability backlogs are, again, rife across this industry. We're probably 5 to 7 years behind on average in maintenance. Again, sounds a ridiculously big number, but if you look at the maintenance programs of the major players and how we're doing against them, we're very, very behind on maintenance. Yes, lots of things going on to try and improve it, but limited sustained improvement around that. But 2 words that come up, which are very current, and if in 2014 you're looking to persuade somebody to invest in you, to work with you, or to collaborate with you, then if these 2 words are things that you can use positively, then you're going to get a much better response. The first of those is predictability. Is what you're saying pretty accurate? Are you going to get the outcome that you're describing? Whether you're exploring, developing, or producing, predictability is a gold standard. We don't have a lot of predictability. The more, the better. Affordability is the other word. Can we afford to do this? Can you help me describe why and how we should invest in this particular activity? Affordability, as I mentioned, for the super majors in that original chart, is the #1 question right now. We can't afford to spend $230 billion, at least that group can't, again this year. So what should it do? It has to make some choices. Predictable and affordable. If you're both of those things, you're in good shape. If you're neither of those things, probably not. That's it.
Right. Any questions? Yeah, please, at the back there.
Yeah, I'm Jonathan Popper. What you talk about is fundamental underperformance in the industry in terms of production and in terms of development, cost and time. So one gets asked the question, is there a systematic bias in the decision making? If things were statistically normal, you would expect some projects to come in ahead of schedule, below cost, some projects to come in after, but it would average out. That's clearly not happening. So a deep question, what is wrong in the decision making that is getting the industry to invest in projects which, if they knew what was going to happen or predicted reasonably well, they wouldn't invest in?
Well, decision making is trying to get the right outcome based on the information you have available to you at the time, right? That's what we're trying to do when we're making an investment decision or a strategic decision. However, I think the industry at large has miscalculated the amount of information it doesn't have available to it. So we seduce ourselves into the idea that this technical rigor that we can display and the the marvellous technical innovation that we can produce gives us tight outcome conditions where we don't have those. So most everybody will tell you that we didn't expect that to happen. We didn't expect that to take so long. We didn't expect that to cost so much, even though the pattern for the previous decade has been exactly those things. So in decision making, we somehow managed to blank out all of that uncertainty that we don't like and manage the technical risk that's put in front of us. So you know, it's a pretty simple conclusion, but it's one where again, management teams are trying to make good decisions, but I'm not sure they're always aided by the information that's put in front of them.
They're making bad decisions.
Well, oftentimes they're not making decisions. Oftentimes they're nodding things through. Yeah, we talked a little bit about the kind of people who are running some of the big oil and gas companies today. And I include in that the big national companies today. If you think about some of the regulators who are helping make these decisions as well, the level of experience in the industry can be pretty low. For example, to take the regulator in the US, it's a whole brand new bunch of people with very limited industry experience. And so getting things moving there is pretty slow. Again, the unconventional revolution has been a revolution on private land, not on federal land. You know, the decision-making processes are stuck. So yes, it's a little bit about experience and bad decisions. The rest is not looking at the whole picture.
Okay, good. Anybody else? Yeah, please, over there. We just hang on for the microphone.
Nick Waith from BP. I was curious by the statement that you made that JVs tend to work much better than operated by others. Could you elaborate on that and give some examples?
Yeah, I think joint ventures are an interesting setup. So the difference being a joint venture being an independent entity sitting in the middle of a group of companies that generally has a board. The joint venture is then the operational arm that executes the activity. So joint ventures have been a very successful modus operandi particularly in the Middle East, certainly in the Far East as well, and we may well see joint venture operations in other parts of the world. We've seen them in Russia too. Those things have tended to work relatively well. Not all of them. Not all of them. You're thinking of one big one that hasn't worked particularly well.
There's one that begins with K that sprang to mind.
Yeah, but I mean the rest of the industry, the examples and the history of many of those ventures that have existed for 30 plus years have served the industry very, very well. OBO operations tend to get into a bit of a tangle. There's a bit of an ego problem as well about how good an operator is and how much help they need to make good decisions. But again, my experience is that joint ventures largely have been a very effective vehicle. That particular one we can have a long discussion about which version of the joint venture worked and which future version might work. But it's an interesting challenge. The other thing I would say as well related to that is someone was saying about shareholders paying the price, but government often is paying the price for everything we do because it's tax deductible or cost recoverable. And in a joint venture context, that conversation is a very easy one to have. Not a very pleasant one, but it's an easy one.
Okay. Very good. Okay. Thank you very much, Peter.
Thank you.
Thank you for that.